If you have cryptocurrency that you've held for years, this new tax form has just changed everything for you. Most people think that their historical crypto activity is settled, especially if maybe they filed their taxes with this, but it's not. The Form 1099-DA is a tax form that is going to require taxpayers to report their historical cost basis and reconcile that with third party data. And this is going to ensnare a lot of taxpayers with tax issues. And in just a few minutes, I'm going to show you how I'm seeing this catch long term cryptocurrency investors completely off guard. So, my name's Patrick Camuso. I've been working with digital asset accounting and tax planning and compliance for the better part of a decade, long before the 1099-DA existed. And this is, the biggest change in crypto taxation that I've seen in the past 10 years. So, what is the 1099-DA actually changing? So the 1099-DA does not introduce a new tax or change how digital assets are taxed, but it changes the visibility that the IRS has into these transactions. This form is the first time where the IRS is now going to receive standardized third party data that is reporting transactions that are taking place on various exchanges and platforms. So for 2025, it's mainly going to be reporting proceeds. So, this data is going to get fed into automated matching systems that are designed to compare what brokers report to what taxpayers are reporting on their tax returns. Now, obviously, these matching errors are going to surface misreporting between broker reported proceeds and taxpayer reported proceeds. But the biggest risk isn't necessarily what's taking place this year and what's being reported for proceeds this year. There is a bigger underlying risk for long-term crypto investors and digital asset holders. And, that the question is whether your digital asset history, your cost basis calculations that have been cumulative maybe over the past 10 years, it's a question of whether this has been documented well enough to support accurate reporting when you do sell these assets, because then you're going to have to claim and substantiate the cost basis associated with those transactions. So, one of the biggest challenges in the early days of digital assets, and, this is something, again, that I lived through and built my career on at Camuso CPA. So, in the early days of crypto, it had many challenges from a tax and accounting standpoint. To a large degree, it was just structurally undocumented. Early crypto lacked reporting infrastructure, no standardized reporting. Records were put together, self-curated by taxpayers, put together from many different sources. And having data gaps in the cryptocurrency transaction records were very, very common. And, it's very important to understand this in the context of the 1099-DA because, this is the environment in which most of these early cryptocurrency transactions occurred. The exchanges, the protocols, the wallets were not really designed to support tax reporting and accurate accounting. And as a result, tax compliance depended almost entirely on taxpayer created records. And as a result, in many cases, these were fragmented, or in many cases, not created at all. And that's why at Camuso CPA, we're still reconstructing cost basis and doing historical digital asset accounting going back 10 plus years for new clients. So, that's very common, and it's not necessarily bad faith on the investor's part. It's just this legacy accounting debt that they've been carrying for some time due to all of these issues that they faced as an early adopter. So, you might be wondering, well, the 1099-DA, it's just starting to report 2025 and we'll be reporting, for future years as well. Why does the historical accounting matter? So yes, it's going to be focused on 2025 going forward, with 2025 really focused on reporting proceeds. But when you sell a digital asset, the overall gain or loss is going to be determined by not just the proceeds. It's going to be determined by your holding period and the cost associated with that tax lot that you're selling. And the 1099 DA doesn't solve these questions, but it surfaces them. And it requires the taxpayer to now reconcile this and report it correctly on their tax return. So if you have assets that you've held before the 2025 tax year, you can't just start clean that year, because eventually you're going to be selling some of your legacy assets and you're going to have to assign a cost basis to this that's accurate and that's, you're able to substantiate on your tax return when you go ahead and file this and reconcile it with your 1099 DA. So, when you eventually sell these assets, even if you held them for 10 years, you're still going to have to substantiate this basis. And that's where discrepancies can arise. And the burden of proof to substantiate your cost basis and holding period is on you as the taxpayer. So, this is going to create tax headaches for long-term digital asset investors that have this legacy accounting debt, that haven't reconstructed their cost basis. And now they may be selling some of these assets in the future. And, I think maybe there's the perception across some taxpayers that so much time has passed. It was such the early days, maybe they will be able to start fresh somehow. Maybe some of this early data won't matter. But you can see through this 1099 DA and just the overall reporting mechanisms, this is going to be paramount. It's going to be extremely important for you to file your taxes accurately, not overpaying taxes, not cause compliance issues for yourself. So it really all comes down to correctly doing your historical accounting, accurately reconstructing your basis, and getting through all of the accounting issues and data issues that may be present in this legacy data. So, when people get the 1099 DA, they may be wondering, well, why is my cost basis missing? And it's important to know that in most cases, this is going to be by design. It's not going to be a mistake that was made on your tax form. It comes down to the covered asset framework that governs the 1099 DA. And I don't want to get into, all of the details of that because I have done other videos on that. But ultimately, brokers may report basis only for assets that they're tracking continuously from acquisition through disposition within the same account. So for legacy assets, obviously, it's not going to be a fit there. As we move forward in the future tax years, there still are going to be many gaps in this cost basis reporting when that custody lineage breaks, whether it's through transfers, through bridging, wrapping, taking assets into self-custody. There's many types of transactions or things that you can do with an asset that will lead to it being non-covered and not have this cost basis reportable on the 1099 DA. And again, you as the taxpayer are going to have to reconcile that and report that now. And what is required to do that are accurate historical accounting and accurate cost basis calculations. So, the 1099 DAs, it's not retroactively going into these prior periods, but it's tracking the future dispositions. And that is what's really going to start to highlight any gaps or issues in the taxpayers' reporting related to their historical positions through the cost basis that they're going to have to substantiate. So, there's many risks when it comes to this 1099 DA from a taxpayer standpoint. You may have reportable transactions that aren't included on the 1099 DA that you'll have to include from your own taxpayer records. And similarly, you may have a 1099 DA that you get with cost basis that's understated or not stated at all, which is, if you just reported that blindly, you'd be over-reporting that. So there's a chance that you could under-report by not including transactions that are not on the 1099 DA. and a chance that you'll underreport your taxes, or you'll overreport your tax liability by not reconciling your cost basis to the 1099 DA broker reported proceeds. So ultimately, the 1099 DA is not a comprehensive, complete calculation of your digital asset activity as a taxpayer. It's a partial ledger that you as the taxpayer have the burden to completely report for taxes along with any missing information. So ultimately, the accurate tax reporting is on you. The 1099 DA does not replace this, but it is going to start to surface these visibility issues related to mismatched proceeds reporting as well as unsubstantiated cost basis that the taxpayer is reporting. So, how is this going to look as the 1099 DA rolls out? So, enforcement under the 1099 DA will likely begin with automated discrepancy analysis. So, we're going to see the broker forms get filed, tax returns get filed, and then matching will occur. And where mismatches persist with taxpayers that are, not reporting proceeds correctly, there will likely be tax notices that are generated proposing adjustments based off of this. So these notices aren't audits, but they can carry real consequences for taxpayers. And it's important to know that if this 1099 DA is missing cost basis information, that doesn't delay this process. And by the time a taxpayer gets this notice, if they've been in crypto for the past 10 years, that historical accounting better have already been done, because, these types of historical accounting and cost basis reconstruction engagements can take 2 to 3 months, sometimes, even more than that, depending on the level of complexity that we're working with for any given investor. So you need to be ready to not only accurately report this to avoid the matching issues, but be able to substantiate and defend any position that you take. And that comes from having these accurate cost basis calculations. So you may be saying, like, why is this the case? If I had assets 10 years ago, why is this going to shake out now in 2025? And that's because tracking your cost basis for digital assets is a cumulative process. Units or tax lots that you acquired years earlier may be exposed up today. And, you may have purchased an asset like Ethereum and have been purchasing it at different price points throughout the past 5 to 10 years. And during that time, you may have exchanged some of it for other assets. You may have disposed of some of it. All of these different transactions impact your basis. And, if you started purchasing it in 2017, you're going to have an ending basis for 2017 that rolls into the starting basis for 2018. And that basis is cumulative, and it just builds upon itself all the way now through 2025 and beyond. So you need accurate calculations. You need the correct accounting methodologies to be in a position to report and substantiate an accurate cost basis for any disposition for these assets that you're still holding now into 2025 or beyond when you do sell them. So there's really no way around the cost basis reconstruction. Now, another thing to point out, or another consideration, is that software is a computational tool that needs to be used. You need to leverage a crypto accounting software to manage this data and do these calculations appropriately. But software does not solve this issue for you. It's not going to solve the issues of undocumented history, of making sure that you're taking the right approach to your cost basis methodology. So, it's really just a computational tool that is only good as the information that you put into it. Whether, if you're missing acquisition data, or if you're selecting the wrong accounting methodology. These aren't going to be things that you can just rely on the software for. And the IRS does not evaluate tax positions based off of software outputs. So, it's going to evaluate your records, your methodology, your consistency, your documentation, and just simply relying on a tax software is not going to be sufficient from this perspective. It's going to fall on you as a taxpayer. So you need to leverage softwares, but you can't just rely on them or think that they're going to be the scapegoat for any inaccuracies. Ultimately, this falls on you as the taxpayer. Now, another very important point to bring up, because obviously, this all comes down to your cost basis. And one of the biggest changes to how cost basis is calculated for digital assets happened in 2024 with Revenue Procedure 2024-28. And this is something that most taxpayers are still unaware of, and it's going widely overlooked. And this is going to lead to severe inaccuracies when it comes to cost basis calculation. So I've done completely separate videos on this in detail, blogs on this. So I encourage you to check out all that information. I'm not going to go deep into detail on this, but this revenue procedure changed from accounting for digital assets from a universal accounting methodology to an account by account based, wallet by wallet based methodology, which is a huge change. There's an allocation procedure that you have to follow to shift from the universal to the account based when you're transitioning from 24 into 25. There was also guidance given related to spec ID and pre-sale lot identification with standing orders. So these need to be implemented so your accounting is in compliance and your cost basis calculations are actually accurate and can stand up to scrutiny. So I encourage you to go and check out the separate information on this revenue procedure, but to deeply understand that when you're doing the historical accounting, you need to make sure that you align and are in compliance with this revenue procedure if you want to ultimately have a defensible cost basis that you're reporting. So who is the most exposed under the 1099 DA? Obviously, long-term holders that have these historical basis issues, founders that are, liquidating early assets that they got that, probably aren't in the broker reporting regime, multi-wallet, multi-chain users with complex activity. These are going to be, some of the taxpayers that are, going to have some challenges with the 1099 DA that are largely going to be driven by some of the accounting and cost basis challenges related to just tracking their history. So, it really comes down to the data quality and the complexity of your transactions. So, Form 1099 DA, along with, many other factors that are converging, mark the start of what we call at Camuso CPA, the digital asset compliance era. So digital assets are no longer evaluated through self-reporting. They're going to now start being assessed through standardized reporting, automated matching, cross-system cooperation. And compliance is going to become much more imperative, and it's going to be much more important for taxpayers to plan in advance and make sure that they're being proactive with overall compliance, accounting, and tax planning. Digital assets are now entering this stage where, it's an unregulated frontier to where, it's becoming a regulated frontier. And the taxpayers and the companies that are going to survive this with their bottom line intact are the taxpayers that are able to plan ahead for this and get compliant and make sure that they're on the right side of this shift that we're all experiencing now. So, if you've been transacting in digital assets for years and you've never fully reconstructed your historical accounting, or you've attempted to, and you're not confident in the accuracy just related to your accounting and due diligence or related to the revenue procedure or anything else, this is what we can assist at Camuso CPA. We can take your on-chain activity, regardless of the complexity, regardless of the data issues or data gaps, and we can do all the historical accounting and fully reconstruct your cost basis into a defensible position. And similarly, we can assist with the tax planning and compliance related to the tax reporting around digital assets. So the digital asset compliance era is here, and preparation is really the only way to stay out ahead of enforcement and make sure that you're protecting your bottom line. And that's what we're here to assist with at Camuso CPA. So if you need assistance with that, visit my website at camusocpa.com, and we would be happy to set a time to speak with you. Until next time, I'm Patrick Camuso, signing off.